Thank you very much. Thank you to you, and many thanks really for allowing me to contribute to this distinguished panel discussion with an initial presentation. As you said, indeed, the issue is our flagship report on pension adequacy, which offers what I believe is a relatively unique comparative perspective on the capacity of the European statutory pensions system to ensure adequate income in old age. To be very clear, I will give you a couple of good news to start with, to warm the audience, and then the bad news, however, will follow. Essentially, there is one sentence, which is what has taken you here will not take you there, that summarizes. The good news are mostly for the experience till today, and the bad news are whether these can be contained. But let's be very analytic. So the very first element of good news is that the incomes of the older people were comparatively well protected during the recent crisis, both COVID and the war and the energy crisis. Thank you very much to the, of course, temporary anti-crisis measures and the permanent adjustment that have been done to the European pension systems. So in a way, the pension system have demonstrated their ability to protect when the needs arise, and they have demonstrated also somehow their ability to adapt, although slowly. So, for example, our report shows that the length of the working life has increased overall. On average, Europeans now expect to work 41 years on average and spend 21 years in retirement. So longer life, but also longer working life. At the same time, of course, we cannot hide that the risk of poverty or social exclusion for older people is there. I mean, 1 in 5 of the older Europeans are at risk of poverty or social exclusion. They are around 18.6 million, which is a bit of an increase in 2023, which is a bit of an increase with respect to 2019. And obviously, there is a gender dimension into that. The gender dimension, because as we know, women, because of their cares of both kids and elderly people, they tend to work less during the working life. Probably they work better, but less. And so if they work less years, they contribute less to their pension, and therefore there is definitely a gender gap. So this finding, let's say, put to the fore the fact that we really need to think about that. And for example, addressing gender equality in supplementary pensions need to be part of the solution, because if in the pillar 1 you have this hole, this gap which is created by working less, then in supplementary pension these can be mitigated, of course, through enhanced redistributive mechanism. A second point is, of course, that our report points to the fact that low financial literacy is a factor hampering retirement planning. And financial literacy here needs to be intended in a very wide sense, including not knowing, for example, how much pension will you have. If you think that at the end of the day it will be fine and don't worry too much, it may well be that you underinvest, or that you under worry in a way, and you do less than what you needed to do. So this is, let's say, the situation till now. So relatively positive with the gender gap, however, that needs to be covered. For the future, the situation is less rosy. It's less rosy inevitably, and is in our report very clearly. The evolution of pension in the years to come is bound to decrease. The replacement ratio that till now was around 58% are projected to sensibly decrease in the next 3-4 decades. What to do with that? There are many possibilities of what to do with that. One inevitably needs to be the age of retirement. It's clear that the age of retirement is a crucial factor. Even couple of years of more of working age and couple of years less of pension changes the equation quite radically. Let me give you a number. Every year, 1 million people in Europe change status. Every year. Every year, 1 million people change status from workers to pensioner. That means you have 1 million less who contributes and pays into, and 1 million more who takes out. This is the fundamental difficulty that we need to solve, and even a small increase period of working, voluntary, involuntary, whatever, it helps. Two things are fundamental here, of course. One is that when you talk about retirement age, you need to talk immediately in the same sentence about social partners consultation. It's unimaginable to do anything in that area without a proper and extended and well-diffused social partners consultation. And the second is that maybe the voluntary measures can be effective. There is one measure that I always like to quote, is the one of Greece. In Greece, as you know, in Pillar 1, they had a 30% penalties, quote unquote, or deduction for those pensioners who reach 65. They go in pension, but then they continue to work because, for example, they do consultancy or whatever else. They had a 30% pension deduction. What do you think it happened? It happened that many did work, but maybe they were not fast enough to run to the office and declare it and get their pension cut by 30%. The 30% cut generated only about 80 million per year. The Greek government recently decided to eliminate the 30% cut and let the market to play. And then suddenly many more persons found their way to the office to declare that they are working even if they have a pension, and the increase of taxes paid by those who work was 250 million. So about 3 times as much as the benefit from the deduction. So this shows how even little things, actually market incentive, can really help a lot. Now, what we say, and you'll see in all our documents, declaration, and so on and on, is that when it comes to pension, member states need to take a multi-tier pension system approach. They need to look at Pillar 1, they need to look at Pillar 2, they also need to look at Pillar 3, they also need to look at the possibilities that citizens have. And the recent reform trends show, I would say, that member states have understood this message, and there is a certain interdependence between the statutory, the occupational, and the personal pension scheme. So on the one hand, there has been some reinforcement of the redistributive capacity, mostly in Pillar 1, and on the other hand, there has been a sort of a number of incentives in order to take up supplementary pensions, be them Pillar 2 or be them Pillar 3. Now let us be very clear. In order to take up supplementary pensions, transparency on what you will get is essential, because if you don't know what you will get, or if you are under some sort of perception that you will get it, and that's fine, because the older generation has got it, that may be very misleading. We have actually financed an exercise of European tracking service in 5-6 countries in order to make sure that this becomes a reality, and that citizens know what it is. Now I believe for in particular the Pillar 2, but also the Pillar 3, there is a good opportunity which comes from the let's say the revamped Capital Markets Union that, as you have seen in the political declaration, is now called the European Saving and Investment Europe, and where pension inevitably needs to play a very big role. So I think there, both for Pillar 2 and for Pillar 3, there is quite a good position. In a way, citizens may be attracted to that. Citizens are now, what is interesting is that European citizens are saving a lot, and they are investing a lot, but not necessarily they are investing in pension. Probably because they think, as I said, that they are safe in pension. It's important to pass the message, not that they are unsafe, but that a good safety comes with a multi-tier investment. So with the investment in Pillar 1, Pillar 2, and Pillar 3. So I believe on these, DG FISMA and DG Employment work closely, and EIOPA is a crucial partner. Actually, EIOPA, as you know very well, was a crucial partner of our 2019 report on pensions. So I believe this only needs to continue. To conclude, you have in front of you a very important job, because on the one hand, you have in front of you the job of reassuring citizens that there are means and ways to make sure that the pension system of Europe remains what we know it. And is honestly, the pension system of Europe is probably the best of the world. It's the best of the world in a collective terms. How it has been able to protect the social fabric of Europe, and how it has been able to redistribute, but at the same time respect the individual contributions that have been made. But as I said, you have the task to say that these are possibilities. There is a concrete possibility that we have these in the future, but this possibility need to be worked on. So we need to work so to make sure that this happens. More and more, Pillar 1 will be subject, of course, to a very clear trade-off between pension adequacy and macroeconomic sustainability. And on the macroeconomic sustainability, of course, that's more for the state, but on the pension adequacy, that's where your role is very important. So I stop here, and thank you very much really for the invitation and for the attention. Thank you.
Thanks a lot, Mario. Thanks a lot, all. Welcome to the second panel of today. So we heard key insight from Mario on where we are. Good news, as he said, for where we are still today, but also important challenges looking ahead. And this is what we want to dig in now with our panelists. He mentioned 1 million of people per year changing status, replacement rate to be decreased, unfortunately, will decrease in the longer term. But he also mentioned multi-tier approach. This is very, very much dear to our narrative at EIOPA, so we need more. Aging population, fewer people saving, still a lot of space in our view to develop further second and third pillar in many member states. So what we need to do? We will ask you today some answer. Let me introduce the panelist. Alison Bough is from Ireland. Head of Policy and Program at Active Retirement Ireland, the most relevant membership association for older people, psychologist, scientist, expert in behavioral psychology. You will give us some insight on how people behave, basically, with regard to this. Lisa is a professor, director at Netspar, professor at University Maastricht and Tilburg, expert in retirement communication, financial well-being. You will also inspire us with some insight. And then my colleagues in the supervisory area, Stavros, Konstantas is from Greece. Mario mentioned Greece. You will also mention something from your experience. Director of Insurance Supervision at Bank of Greece, member of our Board of Supervisors. Welcome. And last but not least, Matti Leppälä. Matti is a well-known director of PensionsEurope, fitting also many roles in our stakeholder group on pension and occupational pension in general. So you will also be part of the discussion from an industry, if I can say, perspective. But before I start asking a question to our panelists, maybe somebody can put a slide for all of you. A question to all of you where we want to check with you, actually, what, in your opinion, can improve saving? Yeah, here the question, what can improve most saving and pension sustainability for future generation? What Mario said is our challenge nowadays. And I see some clear preference for government incentive and reform. Let's see if it changes, but the number are quite stable. Clear answer that the government needs to act. So this is already some insight for our panelists. And clearly not so much attention to ESG. Okay. It's your opinion. It's not, I'm not... Let me start then with the first question. Alison, I will start with you. We just want to check with you, and if you can tell us real challenges, real life experience from your side, what people are suffering today.
I think I can segue perfectly from the government reform issue and say, and I should put a disclaimer to this particular audience, I'm not an economist, I'm not in the financial sector. I do work in policy in ageing. And I'm a representative for older people in Ireland, but also with Age Platform Europe at a European level. And I spend a lot of time asking government officials and our MEPs and our politicians in Ireland about why pension reform is happening so slowly. So I spend a lot of time asking those very questions. I think in terms of Ireland, unfortunately, I have to say that Ireland remains the naughty child of Europe in terms of our progress in implementing pension reform that's been promised. And we've been very, very slow to implement auto-enrollment, which has been delayed again. For people who are going to retire at some point, but we've been extremely slow to implement benchmarking and indexing of the Pillar 1 pension. We are now the only country in the Eurozone without a benchmarked Pillar 1 pension, which is hugely problematic. So our annual budget every year makes the pension a political football. So we have minor increases and giveaways, and particularly this year in the run-up to a general election, which is happening on the 29th of November. We've had lots of promises made, but the reality is that our pensioners are now operating at €40 per week below basic adequacy, which is leading to huge problems in terms of energy poverty, having to choose between food and heating. And we know that many, many of our retired older people are also in caregiving roles. They retire and they're supposed to be enjoying their retirement, but of course they end up in unofficial caregiving roles for their children's children, for their grandchildren. So they continue to work, but at the moment in my jurisdiction, at €40 below basic adequacy. So it's a really, really difficult situation. We've had recommendations, country-specific recommendations from the Commission on benchmarking and indexing our pension, which have been unfortunately largely ignored. We've had the pension adequacy report, again, indicating that Ireland in particular has a gender pension gap going completely in the wrong direction. And that's been ignored largely, I have to say, by our government. And we have to ask who is going to become a watchdog for the commitments that our government and policymakers made in 2018, that they were going to benchmark the Pillar 1 pension. So we're now coming up to 2025 and there's no sign of this commitment being implemented. So we can talk about the day-to-day reality of poverty and the fact that over 65s are at increased risk of poverty. as a member state, and the gender pay gap, women in particular, are at a hugely increased risk of poverty because largely due to caregiving and lack of contributions. So we can talk about that all day long, and I often do, but what I would like to ask is who's going to implement the pension reform? And if the government are not going to implement their commitments that they've made many years ago, at a European level, how are we going to force member states to implement their commitments to pension reform? Because that's the only thing that's going to make a day-to-day difference for older people and older women in particular who are at huge and increasing risk of poverty.
Thanks a lot. I don't have an answer now to your question, but I can tell you that in our board, the pension topic is quite high in our agenda, and the member of our board are always pushed to make steps. And maybe the Commission can also raise the voice when it comes to government implementation and keeping promise. But thanks a lot for sharing. It's quite interesting. Maybe, Matti, you from an industry side, if you may help a bit here on with regard to the role of sponsor, not necessarily in checking what the Irish government will put in place, but in terms of what the industry can contribute in their role as a sponsor, especially with regard to the auto-enrollment reform that was also mentioned by Mario as one of the possible way to improve.
Yeah. Certainly, Fausto. Thanks for having me. And I think it was good basis for this discussion, what Mario said and what you also said, because Europe has done a lot in pensions, but especially in the social security pensions during the last 25 years to make them, the first pillar social security pensions, financially sustainable, because demographic change, aging, that has been known. And it puts a lot of pressure on the sustainability of public finances. And much has been improved. Retirement ages have been increased. Many parametric reforms have made these systems much more sustainable. But as a consequence, the level of pension that people can expect to receive has in some countries drastically dropped, in some less. And then, of course, we need to fill that gap if we want to have adequate retirement income that is socially acceptable and sustainable. And there we think, as the pension industry, that the role of supplementary pensions, occupational pensions or workplace pensions, whatever they're called, and also private personal pensions, they can play and they should play a role. But there hasn't been that much emphasis on that. And that really stems from the fact that occupational pensions are part of the wage package that the employers offer. And if we look across Europe, where you have the strongest occupational pensions, they are the countries that have well-developed collective bargaining systems, like in the Netherlands, covering most of the workforce, providing very good benefits based on collective agreements. The same in Denmark, in Sweden, but in many countries these do not exist, these systems. So you don't have, as part of the wage package, these types of supplementary occupational pensions that would then compensate for the decreasing social security pensions. So you need other measures, and I think then what the governments can do, as the governments are responsible for the design of their own member state pension system, some have opted to go for auto-enrollment systems, like Ireland now rolling out, where the employers will play an important role. And as in occupational pensions, as they are part of the wage package, it's part of the remuneration, it is important that the employers play a role. We have another auto-enrollment system in Lithuania that has been successfully rolled out since 2019, now covers 75% of the people. That is done by the social security body of Lithuania, not by the employer. But then you have a problem then that the employers are not involved, they don't contribute, they don't govern. In the best systems, occupational systems, those who pay, both employees and employers, they also take responsibility of the system and they govern it. They are the stakeholders who govern the pension funds. So the pension funds are really and fundamentally social institutions. They are active in financial markets, but they are social institutions. They are not the state, they are not businesses, they don't sell products. They are there in between as part of the civil society. And that is really important to understand and to respect that they are different. But auto-enrollment indeed has played a big role. Like if you look at the UK, since 2012, more than 11 million people have been enrolled into supplementary pensions. With auto-enrollment, you have employer participation. The contribution levels are not adequate, but that's another problem. But in auto-enrollment, successful auto-enrollment systems, if a member state introduces auto-enrollment as part of the pension system, it is crucial that the employers play an important role. Without employers, there's no example where this has been successful as a whole. Even in Poland, where when they changed the pension system, they nationalized half the pension assets some years ago, and then they introduced a new long-term savings product, PPK, which has been quite successful, not as successful as the Lithuanian auto-enrollment, but still successful. Even there, for a long-term savings product, the employers play a very important role in gathering the contributions, in managing the system, in contributing to the system. So even when they don't call it a pension, but it's an auto-enrollment long-term savings product, the employers do play and have to play an important role.
Thanks a lot. So a key role for the employer in the designing a system of auto-enrollment is recommended. Lisa, what is your suggestion when it comes to member state fostering more supplementary pension system, especially now in this context of more defined contribution, more responsibility for the individual to take risk, be wise in taking risk, while for long people were used to somebody else to take this responsibility, the state. What's your...
I think it's quite interesting that both in the Slido as well as now in the discussion, we actually already mentioned the three levers that you can pull to bring about change. So on the one hand, policy change, you can look at the products, and of course you can work on awareness, financial education, and on the individual taking action. All of them are important, but the evidence base is actually very clear that systemic changes is what's really bringing larger and more sustainable changes. There's a very nice paper from George Löwenstein, a very well-known behavioral economist from Stanford, who has done a lot of research actually initially focusing on individuals, but he wrote this paper, the I frame and the S frame, and he makes a very compelling case that if you focus on the individual, you really have to understand the behavioral biases that make it so difficult for them to take care of their own future when it's far ahead in the future, when we make different trade-offs in the here and now versus the future, if we don't have the literacy, we don't have the self-control. And so he also shows nice examples from retirement where he says if you instead focus on systemic changes, you can reach larger and more sustainable effects. And auto-enrollment is a really good example. Of course, then a proper default is also really important, because otherwise people may also think like, yeah, I have a pension plan through my employer, it should be safe. And maybe too late they found out that, you know, the contribution rate actually would not bring the retirement income they had expected. So I think my first point would really be the systemic change. I think it's really, if we're really serious about protecting people and decreasing old age poverty, I think this is where it will really have to happen. But also there, of course, overcoming behavioral barriers is a really important point, but maybe we get back to that a little bit later in the discussion as well.
Thank you. Stavros, you were also mentioned in a way from Mario when he referred to Greek experience. Can you share with us the...
First of all, thank you very much for the invitation for this panel. I think he didn't mention me in person, right? He mentioned something in Greece. Okay, yes, in Greece there were some pension reforms that happened the last years, definitely due to the severe financial crisis that Greece faced in the last decade. The Greek pension system in the first pillar comprises practically of three pensions. The one is a state pension, which is a flat amount for all those eligible over 15 years of service, and it's an amount that is very low. Then we have a contributory pension, which is proportionate to the contribution during the work lifetime. And then we have an auxiliary fund, which is also a contribution going to this fund. All these layers that comprise the first pillar have pay-as-you-go system. Now, Greece is a country that has a severe aging problem. I think it's one of the highest in Europe. And also, Greece has the highest, along with Italy, if I'm not mistaken, contribution rates in Europe. So, as you can imagine, the financial crisis led to some reforms, which were not very easily accepted. Increasing normal retirement ages, freezing of indexation of pensions, and some other measures, unification, clustering of different funds, harmonization of regulations. So a lot of things that sometimes were not pleasant for the pensioners. One of the things that I wanted to mention at this stage is an effort that was made on the first pillar, and it's the creation on the auxiliary fund on a non-pay-as-you-go basis. So the government took a step on the first pillar to gradually substitute the pay-as-you-go auxiliary fund into asset-backed pension. This is called TECA. This started in the beginning of 2022, and it's eligible for all those, it's mandatory for all those that are born after 2004 and enter the labor force after 2022. And here, the concept is that gradually, over the next 40 years, according to the projections, 90% of the old system is substituted by the new. What's the benefit? More professional governance in this system. Of course, at a later stage, more investment options, because right now it's an infant stage. We have around 500,000 employees joining this by obligation. And the concept here is that with this effort, the government is trying to create a viable and sustainable system for the future. Is this, and of course, it will be fair for the generations. So it's an effort of an asset-backed pension in the first pillar. Is it without cost? No. Of course, you can imagine that the old pension system on a pay-as-you-go is losing the contributions that are channeled now to the new fund. But this is estimated to be 300 million years over the next 10 years. It will be financed by the state. But on the other hand, the benefit is that younger employees will have their own individual account, and they will be able to visualize what their accumulation of funds is, something which is missing from all those pay-as-you-go systems. And the second thing that our government decided to give as an incentive is that the amounts of this special fund will not have negative returns. So in other words, there is a contingent liability of having non-negative returns. So we consider that something that is to the right direction, along with what Mario said about the pensioners and the fact that if they want to work, they have to sacrifice part of the pension. I think it's to the right direction, of course, at an infant stage right now.
So non-negative return, can you elaborate?
Non-negative return means that in case that the investment return becomes negative from the contribution, the government will cover the deficit. So it's an additional comfort to the employees that, look, you are not going to lose money, because all this financial crisis and the things that followed Greece showed that there were some problems. Pensions were reduced, and this we have to make sure that the young generation will not face again.
Thanks a lot. Quite interesting. Matti.
Could I comment on?
Yeah, please go. I see that you wanted to.
Yes, thanks, Fausto. I mean, increasingly, people in many countries need to voluntarily choose whether it's an auto-enrollment that you then can opt out. So you can choose, you will be re-enrolled again, but still there is this element of decision-making, which was not the case in many occupational pension systems. Of course, also for the employers, if it's an auto-enrollment system, they cannot choose either. They have to provide what the system will provide. So that is important in these behavioral aspects and understanding this and understanding the risks and the benefits. And there, I think, needs a lot to be done. And also, when thinking about the role of auto-enrollment and employment and pension policy and government actions, we have to recognize that we have increasingly a big number of people who are outside the scope of the traditional occupational pensions. We have self-employed, gig economy, platform workers, and there, of course, the governments really need to put in place policies that also these people will be covered. Many countries have already done improvements in the social security pensions, but then also the occupational and personal pensions need to play a role in providing adequate retirement income for these people. And there are many different measures. You can have the platforms contributing, you can have the customers contributing, you can have government subsidizing this, but all in all, this is really important that these are new challenges that need to be faced, and there also the behavioral aspects, I'm sure, are even more important to convince people who are not necessarily mandated to save, that it is worthwhile and important for them to save also in these new types of work.
Thank you. Then I will ask you something about the accumulation strategy, but maybe before coming back to you on this, I would like, after the intervention of Stavros on the reform in Greece, from your side, you mentioned already the, let's say, the not so high speed in Ireland. What do you suggest? What can be the concrete step that the member states can take to make reform, even though we know that are politically quite sensitive? Whenever you mention pension, I know Stavros mentioned the Greek experience, I know the Italian experience, there is always a strong debate. But concretely, what member state can do as steps to put in place?
I'm certainly not the only one who is cynical, but I might be very, very cynical given the speed or lack thereof that the Irish state are moving in towards reform. I will say, however, that Petra mentioned in her opening remarks the idea of a pension dashboard for policymakers, and in terms of where to spend the money when needed. And that is certainly something that I would have to second that statement, because certainly within Ireland, and I can't comment on the majority of other member states, but we do not appear to be, our policymakers do not appear to be using a data-driven approach in terms of pension reform and where to spend the money. And I think there are huge gaps there in the Irish context, and I am cynical, but we're getting these populist kind of one-off pre-election boosts. But if we are to actually drive down on the data, you would see that, for example, for the last 3 years in a row, we've had a €12 annual increase to the Pillar 1 pension. So nothing has changed. so rather than using politics and boosts and promises, if we could move towards a data-driven approach for our policymakers, that would certainly be a very welcome concrete step in terms of reform.
And you mentioned pension dashboard. Ugo, you know that we provided the Commission some piece of advice in the past. We are waiting for concrete maybe initiative to be taken. Let's wait the new commissioner.
Some of us are always providing advice and waiting for a response.
Thanks a lot. Matti, back to you on the focus on the decumulation strategy. Greek system seems to have provided an answer for safety with the non-negative return. From an industry perspective, what is the focus on when it comes to the investment horizon to ensure good outcome, good result, good return for people saving?
Yeah. I mean, this far, most pensions in Europe have been defined benefit pensions, and they have been very much annuities. And of course, during the very low interest rate environment, the annuities markets became difficult, and then pension funds were also looking to get better returns and more flexibility and different solutions to provide better income in the end. And then there are many ideas to improve this, taking also investment risk during the retirement period. And that, of course, comes with challenges, as if you put increasingly responsibility to the individual to decide, and you're faced with then older and older retirees. There's a lot of studies that also point out that the cognitive ability of people may diminish, and it gets increasingly difficult. So I think what is important is to design good, not maybe perfect, but good enough default options for people to have then in the end. And as the whole system in Europe is moving towards defined contribution, then the decumulation phase issues become much more important for the pensioners, for the retirees, because then they have much more risks and much more to decide. And of course, the decumulation phase, like how much money do you need? Will you run out of money? Do you save too much? There are at least 3 Nobel laureates who have called this the most nastiest problem in economics. So we cannot assume to put this burden on individuals. So we need to take it seriously. We really need to concentrate on the decumulation phase issues, especially with the change towards defined contribution. We have already many countries in Europe that are very much defined contribution, and they're coming into the phase where the people actually start to retire from this system. So this is a very, very crucial issue, and we need to have good thinking and good solutions sooner than later in this. But as a whole, the landscape is changing in this respect very much, and different solutions and good enough solutions and flexibility are needed. So I'm sure annuities will be an important part in the future as well, but also taking investment risks and getting to better retirement outcomes will also be a very big part of the future decumulation phase.
You know that we are developing this concept of value for money for some product, long-term product. Is it something that you want to embrace in the pension area?
I mean, pensions, of course, have to be cost-effective. And if we look at occupational pensions, they are very cost-effective. If you compare them with financial products that are sold to individuals, they are very cost-effective. There are many studies to show, because you lack the marketing, you lack the profit margins in many ways. So they are cost-effective. But really, pension funds, of course, need to provide the best possible outcomes with low cost levels. So value for money is really important for pension funds as well.
Good, and we also need as also Alison said, some data-driven approach. So on the pension area, we have a lot of data at EIOPA, but we can still improve on the data-driven approach. More data will allow us to make more analysis and inform well-informed decision. Lisa, when it comes to people, how we overcome a behavioral barrier to save? Because there is still this tendency, to short term, maybe from people. From your perspective, what is the key step that we need to make?
I think a key step is that I think the sector also really challenges itself. And let me make that point clear by telling you a little bit an anecdote. My background is actually in service design and service research. And I only entered the pension world around 14 years ago. And in that service design, service research, if I would make a drawing of such a conference, I would make a big bubble in the middle and write pension saver there and somehow visualize also the heterogeneity and really put the people for whom we are doing this central and their needs and their wants and all that we do from policy, regulation to product around that. But when I entered this pension world, I realized this is not the way that this sector thinks. It's a lot about the technicalities, the products, the details, the calculations, the regulations. And I once said, I think a definition of communication in the pension sector is the legally correct transfer of information. And it has very little to do with how communication is defined in any other sector. And I think there's really, honestly, so much to learn from this sector and become better in communicating in a way that resonates with people. And let me give you examples. Luckily, there has been quite some research also over the past year, also made it a little bit my personal mission to bring about change in this area. I did quite some research on my own, but also now as director of Netspar, we sponsor a lot of research. There are nice studies by psychologists, or consumer behavior expert or behavioral finance. For example, it shows that the power of words. So if you take a message from a pension fund to the pension savers, there was an experiment where they adjusted only 4 headings in that letter. And guess what? They could double the response. Twice as many people took the effort to read and to take action and to log on. There are a lot of other factors that we know from behavioral economics and psychology that you can use in your communication. Visuals are very powerful. We process visual information much quicker and more holistically than written information. And there are nice examples that if you, for example, show a euro sign instead of just a wallet or something else, then also the response by people goes up by 30% to log in and see how their retirement planning is going. There are very nice examples about user-friendly tooling where people get the information. We did a field study where we looked at tooling in combination with financial advisors and how people value that, how it affects their choices, how it affects their decision comfort and trust. There are nice examples where pension funds or insurance companies actually collaborate with employers to go to people where they are, to go to the canteen or to have a coffee cart, give people free coffee and talk to them about pensions, or to actually draw the attention not only towards retirement income in the far future, but also survivor benefits, which is something that's also relevant in the here and now because you often want your partners and children to be well protected. There are lots of examples out there. And in the Netherlands, for example, in November, we always have the pension 3 days. It's not a very nice translation, but 3 days in which a lot of attention in which there's a lot of attention for pensions. So on central stations, in the news, through pension funds, in the newspapers, radio. And every year they also give out an award for the best initiative in activating and engaging pension savers in raising awareness. And I think these are really great examples because we still need to do more research and get better knowledge on what works, but also share that so that in total, I would say the approach towards pension savers is really improved.
So we provided an advice to the Commission, again looking at you, at Hugo, on the pension statement, the benefit statement. But I understand that there is a lot still to do in terms of better communicate to people, no?
Yeah, and of course, I mean, in communication, there are always dilemmas, you know, and also in what you are obliged to communicate to members, a lot of that information is highly relevant and it's important to protect them. But I would also argue, if it's just this long list of things, it works like the cookie policy on the internet where people just click yes and don't bother to read it. I think we should really use the insights from behavioral economics and psychology and communication and think about, okay, how could we maybe layer that information? Make the essence very simple, because we also have research that shows if people understand that, then they often want to know more, because that shouldn't be an exercise in itself. We do that to protect them so that they understand the vulnerabilities, that they understand what they can expect in the future. And I would argue there is still work to be done.
Yeah, I'm sure, despite the fact that we are actually using a lot of research before producing any advice on how consumers really behave. Matti, I saw some movement. You want to jump in?
Very reactive, Fausto, very good, responsive. No, I just wanted to say that I think trust is really the key. And whatever the design of the pension system, whatever the components, if people don't trust it, it will not work in the end. And increasingly, we are moving in the direction where individuals need to act more responsibility, more risks are with the individual, and then they need to know even more. So I think everybody needs to know, the communication needs to be beneficial, it needs to be good, and especially with the change towards defined contribution and relying more on people's own willingness and choice to save and continue to save for the long term, it becomes ever more important. And then, of course, the behavioral aspects and the behavioral science experience that there are around the world, I think is really relevant to see what are the issues that are important, how do you do this in a way that it is actually effective. So I think everybody needs good communication. These pension tracking services are important. They can help very much. And also on the dashboard issue, I think it is important that the member states have a good view of the situation. How that can be done can be tricky, but it is really important. And then to use from the European level, as you mentioned, the country-specific recommendations, not just in the first pillar pensions, but also in relation to second and third pillar, to nudge at least member states to the direction that they improve also these parts of their pension system, not just the social security parts, where the emphasis, and rightly so, has been for the past decades.
Thank you. Stavros, we haven't mentioned yet a good supervisory system, but we count on you to describe what are, in your view, why is needed in the pension area specifically, yes. What are the key elements, what is your experience?
Okay, I'm the last speaker before lunch, so I try to keep you alive. First of all, it was just mentioned trust. I'm referring, first of all, to the second and third pillar. Trust can be gained to the consumers, because it's a very fragile issue, by a robust supervision. And our role as supervisors is not more key, it's very, very important. We gradually see that the individual becomes more and more, in all countries, responsible for his own retirement future. He relies on the states on the first pillar, but for the second and the third, he has to develop. Greece, unfortunately, is an example where the second and the third pillar are very, very low. So we see gradual shift of costs to the employees, to the policyholders, where our supervision there, risk-based, has to see if the costs are justified, and I will come to that later. We see gradual shift of risks, and our role as a risk-based supervision, we have to see if the risks transferred are managed properly. And investment guidelines that are approved are also strictly followed in the right way. So, core elements. Because in Greece we had a lot of changes in the regulatory pension schemes, etc., I would say a stable and clear regulatory regime for pensions is important. And by stable, I mean not changing and making a confusion to generations of pensioners that could create an administrative fuss that we faced in our country. Second is a clear oversight mandate to the regulatory authority that has enough skillful employees to act, to be able to have the freedom to exercise the regulation and adapt to this rapidly changing world. That's the second thing. And one of the things that we are responsible is also to create trust among the consumers is the flow of information. I'm referring again to the second and the third pillar. And yesterday we had, during a dinner, a very interesting discussion. We provide too much information because regulation provides so in order to protect the client, but I'm not sure if we have fulfilled our goal. The goal has to be that we have to have smarter and simpler sets of information that can make the potential insured policyholder to understand what he's getting. Because in the end, what we see right now is piles of information on the MiFID style for the banks or for the insurance EBIPS products, the investment products, are in such a way so complicated that no one knows what he's really signing. So how can you build trust in this area, and how can you create this? Now, I will come to EIOPA. I think EIOPA is an institutional cornerstone for shaping the pensions in Europe. I'm not saying that because I'm a European in EIOPA Conference. Again, this was the comment. But I believe that there were a lot of initiatives in the past where they provided to European Commission some technical support. I would refer to PEP. Okay, this is not a successful story because maybe the insurance undertakings did not take it. The examples are not as expected. But here, maybe I have to say that the reason may be not the design of the PEP. It's probably the tax incentives that are not existing. And this is something that, again, relates to the things we said before. Now, a second thing is the pension dashboards. It was mentioned many times by Petra, by you, Fausto. It was an effort, again, technical advice to European Commission. And I think it's difficult to extract the data. The data cannot be homogeneous, so some comparisons might be difficult, but it might be a useful tool for the policymakers at a European level, as Petra said, I copy that from you, that really they can do something for overall for the European Union era. Again, it was mentioned, and I wanted to mention value for money for investment products and retail investment strategy. Excellent tools for supervisors to execute their role. Last but not least, I would like to say that something relevant to what Alberto said. We see that even in the second and third pillar pensions, there is some activity cross-border. I think our role as supervisors is to use EIOPA. We have the excellent example of the college cooperation, which is excellent, to converge supervision policies and to exchange ideas as supervisors. And I think it's something that we can improve as we see this develops. In a nutshell, closing, I would like to say that we have to show the role that insurance is an institutional player that gives long-term guarantees that no other institution can give, can accumulate billions of euros that now are sitting, I call them sitting deposits or sitting savings, and they can become dynamic investments in a green and sustainable society according to the Capital Market Union project. And we have to take this opportunity. That's what I wanted to say.
Thanks a lot, Stavros. You made also the link with the previous panel. Maybe now is time to check if our audience, I see already Alexandra. Yeah, okay, let's start with Alexandra. Somebody can have, offer her a microphone to try to talk with us. I don't know if without a microphone will work. Yeah, okay, go.
Hello, Alexandra Mączyńska from Better Finance. It was very good to hear that trust came up quite often in the discussion. I think one of the ways to encourage people to save and have them trust in the pensions saving system is, of course, to offer cost-effective products and good, decent returns. In fact, EIOPA rightly points out that the main risk of a pension product is not achieving the retirement objective of the saver, which is, of course, pension adequacy. And so from the saver's perspective, when I hear, and I don't know the details of the reform in Greece, but it sounds concerning to me, when I hear that the government will cover the deficit in the negative returns, because my question is from where the financial resources to cover this deficit would come from. I guess from taxpayers' money. And I, as a taxpayer, would not like to cover the deficits. And I think that in many, at least not many, but in some member states of the European Union, pension savers are really enjoying quite good situation, financial situation, and can sleep fairly confidently and not being afraid about poverty in retirement age. And I would really encourage member states to look to those member states, to look at the solutions that they have adopted. And I think in those particular member states, there is no coverage of deficits and negative returns from by the government. So I would rather not be happy if in the member states that I have my pension, this was the adopted solution. So, and value for money, thank you also for mentioning this. And one additional point that I think would encourage savers to invest and save would be transparency, especially on the real returns of pension savings. Better Finance does annual research. And to be honest, the availability and access to data is deteriorating each year, and it does not really encourage trust, I must say. Thank you.
Thanks a lot, Alexandra. I see that it's not really a question, but some good consideration. I don't know if anyone wants to react, but we have also a second question here, close to the Enea. Yeah, please go.
General note, because trust for sure is super important. In Dutch, there is a saying that it comes by foot and it goes on a horse. It goes away by horse. So I think it's important to realize that it takes a lot of effort consistently over the years to really build it, and you can use it very quickly. And I think it's also important that there are a whole lot of different factors that really play into this. It's really a very holistic, overarching thing. And it's important to really make clear how you're trying to build this through all these different ways over time.
No, but thanks a lot. I will give you the floor. There is one point that I also share with Alexander, the data. As I already said, we can further improve the availability of data in there. Matti, your reaction?
Yes, just to me, the Greek example just highlights the fact that every country has to have their own policy which fits their own realities and their own system. And if and when in Greece this is an important part of building trust, it is important. I'm sure that nobody wishes that the government has to then pay, but it is there to help. There are many pension systems in occupational pensions, for example, that there is no government backing. In Germany, the pension promises are very strong. The companies who promise to pay pensions, they are liable with all their assets, and still behind that you have a insurance protection for if there is a default. You have a pension protection fund in the UK, You have the Pension Benefit Guarantee Corporation in the US. So you have different structures that fit different countries and different realities, and they all, of course, then build trust in the system. Then on the data and transparency, I fully agree. And of course, there's been much more reporting requirements to EIOPA, to the European Central Bank, so we have much more from the institutions reliable information now than we had before, and I'm sure we will continue to have more transparency, more data on all of the relevant issues.
Thanks for the support. If you want, yeah.
I have to agree. One part of my answer would be that every country has its own peculiarities and exceptionalities. Look at this stage. Greece has undergone a very severe financial crisis, and everything is, trust was totally ruined in the system, because even pensioners saw their pensions reduced. Payments in action, so annuities in payment. So there had to be a way that the new members of the system, and I told you that by the next, or even if I didn't mention that the plan is that the 90% of the system will switch in the next 40 years. The government is planning, to my information, to create investment offices that will take professionally the investment returns of the specific fund in order to have much more better returns. We see some example in other countries as well. So maybe this is a contingent liability of not very high value right now. But still it's at an infant stage. And at this stage, the government made the choice to protect the members of the pension system, because the pension system was so much destroyed and the trust was destroyed, so they made this choice. That's all I will say.
Good, thanks. We have another question. Yes, please, can you
Yes,
yourself?
thank you. I'm Axel Kleinlein, now independent actuary, have been head of BDV and president of Better Finance in former times. And I still have a very close look at the value for money concept, and especially on pensions. I've been very happy that you mentioned the decumulation phase. And this is quite a very crucial point for pension products. And if you want to use the value for money concept for the decumulation phase, there is not so much discussion at the moment already about it. Yesterday at the conference of the BaFin, we had this topic too, and but they don't have a solution at the moment too for the decumulation phase. We made a study early this year for some special German products, Riester and Rürup-Renten, and we also looked at the decumulation phase from the point of view of the value for money concept, and we found out that especially in the decumulation phase, because of the special rules the actuaries can use for diminishing the annuities, the value for money in the decumulation phase is really destroyed in some cases. So my question to you is, do you know concepts of value for money for the decumulation phase? Is there any member states that uses the concept of value for money already in the decumulation phase? And a question to Fausto, are there plans in EIOPA to establish something like a benchmarking for the decumulation phase in respect to the value for money?
Matti, you.
Yeah, I mean, good point, and I would say that, I mean, I just read somewhere a group of actuaries tried to figure out the decumulation phase, and it took them days. So I would not put this on any individual. I mean, I know actuaries are also human and individuals, but still I wouldn't do that. We as PensionsEurope, we are working on a decumulation phase paper now. So we're trying to map what's going on and what should be the future. So really basic ideas, and I hope it helps our discussion with EIOPA, because you are working on your blue paper on DC, which will look at accumulation and decumulation. So I think it's really important that we take this forward-looking and analytical work together. I'm not aware of any country that uses this concept already. There may be one, but we have to find out. But it is really important that we really take the time to look at this now and don't wait for all the problems to come up in the future.
Stavros, you feel free.
Yes, I'm also an actuary, so I just learned that I'm a human and individual as well. I think in the topic of value for money, we're having some discussions, and I think the decumulation phase has to be taken into account. That's my personal view, but we will share it among our board with our chair. So, but the takeaway is I'm human individual as well.
No, thanks a lot. And it's definitely also part of our ambition in the future to expand the concept of value for money. But let's go step by step. We need to... Any other question? We still have a couple of minutes from the audience still. If not, yeah, I see somebody there. 4 minutes for the question. If you want an answer, even less.
Okay, then let me start. My name is Güngör Taner. I'm part of Commerzbank Group, and I would like to come to the Slido question where you ask what's the most important fact. I opted for the financial education and literacy, and I think that's very, very important. And we keep talking about it in Germany for 20, 25 years. Next to my profession as a banker, I'm also a father. And I think we have the privilege that we can educate my kids on these things. I think that's very, very important, and that is a question to the esteemed audience here. In how far are there exchanges with the education ministries, etc., to embed this in the curriculums? Was that okay? Time efficient?
Excellent, thanks.
Welcome.
Yes, please, Lisa.
Yeah, so very good question. Let me first also say that it's also a topic that has been studied widely, and quite recently there were what we call meta-analyses. You don't have to bother about the term, but what it essentially means is that they looked at all the research out there on financial literacy and financial education, and they tried to summarize what is now the effect of this. And the first study that did it, they found that the effects are very small and not very long-lasting. The second study made a cleaner selection and only looked at proper studies, and they did find an effect on financial education and financial literacy. But so I would also agree it is an important concept, but also keep in mind that you have to put in a lot of effort, and step by step you are increasing it a bit. No, you cannot expect the big steps there. There are lots of nice initiatives there. I know that actually in the Netherlands, we have the MoneyWise platform attached to the Ministry of Finance that really looks into financial education, and they have exchange with a lot of similar initiative in all the other countries, and they also exchange best practices and ways to foster education. And there are, in the Netherlands at least, also programs where people from the financial sector go, especially to secondary schools, often also to the more applied programs, but sometimes even to primary schools already too. And they have also educational materials and things that they give out to already start in school with the financial education, and then to continue with that. And I recently saw also a study where it showed that apparently had some effect. So I think it's definitely good that it happens. But also, again, the discussion we had before, and the systemic changes you will reach more. And maybe also as a final point, because literacy is a bit of a container term. Actually, in the literature, they often just look at whether people understand compound interest and that a stock is more risky than a bond. I think it's nice to know, but for your retirement planning, maybe not the most important. I think someone also said, maybe, you don't even understand what you have there, or people don't even know the pension provider, or very basic details. I think for retirement planning specifically, different skills are needed, and maybe not so much even the knowledge, but more so that you have the confidence to engage, and that you know where to find reliable information.
to that briefly and say that we are not just talking about financial literacy, we're talking about the digital divide between generations. So, you know, you have to take into account the digital divide into digital financial literacy as well for older people. So just that the sector, you know, reminds itself that there are many compounding societal factors and divisions for older people, you know, as consumers, but also in terms of trust. And we keep coming back to this key word of trust. You know, trust is built, and it's built through reform and, you know, promises being implemented, but it's also built through, you know, trust in having the key skills to be able to access your financial information, and the digital divide is a huge factor in that. So it's a really important issue for many member states, and was significantly worsened post-COVID as well, where many older people were forced into kind of digital literacy that they didn't have, and those skills. So just to say it is a very important issue.
Thanks a lot. I don't know why when I hear about older people, I come to be more and more interested. Thanks a lot. It's now time to break for lunch. Enjoy the talk around the lunch, and a round of applause for our panelists. Thanks.